Warren Buffett is, without a doubt, the greatest investor in history, and his journey is a true milestone in the world of finance. If you had invested just $1,000 in his investment company when it started, that amount would have grown in an extraordinary way, surpassing the impressive $30 million mark today. These numbers may seem like a dream, something that only happens in movies or fairy tales, but the reality is that these returns are entirely tangible and achievable. So what is the secret behind this incredible financial success? The answer lies in the way Buffett views the market and the principles he adopts, principles that most people fail to understand. Unlike most investors who seek quick formulas or strategies based on market trends, Buffett took a more difficult path, but one that is undoubtedly much smarter and more solid. He built his fortune on timeless principles that not only challenge the common notions of what is necessary to succeed financially, but also provide a proven formula for thriving. What's most surprising is that these principles are not exclusive to billionaire investors like him. They are accessible to anyone who wishes to learn and commit to changing their mindset about money and business. Anyone with a little effort and willingness to learn can apply these teachings and begin to walk the path to financial success. The great advantage of learning from Buffett is that his methods do not rely on luck or external circumstances. Instead, he bases his approach on a deep understanding of how the market works and on making informed decisions without being swayed by emotion or haste. This is the true secret to success: being patient, making calculated decisions, and having a clear, long-term vision. These lessons apply not only to the world of investments but can also be adopted in any area of life, from personal financial management to how you approach opportunities and risks. By continuing to watch this video, you will have the opportunity to understand how Buffett achieved this phenomenal success and, more importantly, learn how to apply his teachings in your daily life. It's not just about understanding how he did it, but also about how you can apply these powerful lessons in your life, turning them into concrete actions that, over time, can lead you to a successful and prosperous financial journey. This is your moment to learn from one of the greatest masters of investing and take the first step toward a safer, more prosperous financial future filled with new possibilities. Don't miss this unique chance to change your perspective on money and business and begin building your own financial success story. Now, regarding the qualities we seek when hiring people, Warren Buffett reveals 3 key traits we look for: intelligence, initiative or energy, and integrity. He emphasizes that if a person lacks integrity, the other 2 qualities can be harmful. In other words, if you hire someone without character, that person will be able to use their intelligence and energy in the wrong way, which can be much more dangerous than hiring someone who may not be as smart or energetic. When it comes to investments, Buffett explains that investors tend to be guided by very human and reactive behaviors. During bull markets, they get excessively excited, and looking in the rearview mirror, they think, "I made money last year, so this year I'll make even more." They end up being swept away by the euphoria, taking out loans or following advice from neighbors who say, "I wasn't there last year when that investor made a ton of money, so I'm going to invest now." They always look to the past, and when they see money being made, they jump in and start inflating prices, and when they don't see gains, they simply say, "This is not a good place to be," completely ignoring what is happening within the business itself. This behavior creates a huge opportunity for those who know how to look to the future and are not driven by the emotions of the moment. Buffett reveals that when he started his investment career, he was taught by Ben Graham to invest based on quantitative criteria, looking for companies being sold at prices below their true value. In 1949, this lesson had a significant impact on him. For years, he sought what he called cigar butts in the stock market. The idea of the cigar butt was to look for cheap stocks with little value, but often these stocks were practically useless, like a cigarette butt thrown on the ground. Although this could generate some return, it was not the path to true wealth. Buffett soon realized that to build great fortunes, it was far smarter to buy great businesses at a fair price, rather than looking for mediocre businesses at a very low price. One of Buffett's strongest beliefs, which he considers old-fashioned, is that he can only expect to make money from things he truly understands. And when he says understand, he's not talking about understanding what the product does or what the company produces. He's referring to understanding how the business's economics will look in the next 10 or 20 years. For example, he knows, in general terms, what the economics of Wrigley, the famous chewing gum company, will look like in 10 years. He's certain that the internet won't change how people chew gum or what flavors they choose. This is the secret to Warren Buffett's success. Deeply understanding businesses, being patient, and investing based on solid principles, not fads or speculation. He does not chase after the latest trends, but instead looks for companies and investments he believes are truly valuable in the long run. When you start to understand the game of investing deeply, one of the first lessons that stand out is the importance of mastering a market. Imagine you own a significant stake in the chewing gum market with brands like Double Mint, Spearmint, and Juicy Fruit. If you have these brands, they will be in the market for the next 10 years, and likely for much longer. Of course, I can't predict exactly what Wrigley's future numbers will be, but the reality is that when it comes to a company with such strength and brand recognition, my predictions will be very close to the truth. Evaluating companies like Wrigley is within what I call the circle of competence. This means I deeply understand what they do, the economics of their business, and the competitive aspects of the market they operate in. And this is a key part of making well-informed investment decisions. However, the biggest mistakes I've made throughout my investment career were not mistakes of action, but rather mistakes of omission, errors of doing nothing. This is something that is much harder to measure because these mistakes don't show up in conventional accounting. I knew enough to act in certain situations, within my circle of competence, but I ended up letting opportunities pass by out of pure hesitation, sucking my thumb. And these are the mistakes that really hurt because they're invisible. But over time, the costs of not acting become clear. For example, one mistake that probably cost Berkshire at least $5 billion was the opportunity to acquire Fannie Mae when the company was struggling and could have been bought for a fraction of its value. That opportunity was lost due to a delay in our decision, and this kind of mistake is what, in the end, weighs on us. But when it comes to a company that's outside my circle of competence, like Microsoft, for instance, I don't worry. I simply don't know enough about it to bet my money or time on it. Microsoft doesn't meet my criteria, so I have no reason to think I deserve to make money from it. Fannie Mae, on the other hand, was a company I understood, but I made the mistake of not acting. These errors of omission are invisible in the accounting records, but they are deeply painful for those who make them. They don't show up in the financial statements, but I know exactly what the cost was of not seizing the opportunity. And it's exactly this type of mistake that, over time, accumulates significant losses more than any mistake of acting incorrectly. In life and in investing, there are great opportunities that need to be seized at the right moment. Often we don't do much, but when a chance to do something big arises, we need to act decisively. And not seizing these opportunities is not just a mistake, it's a giant mistake. Doing this on a smaller scale is almost as harmful as doing nothing at all. This is something we learn over time. We must grab the big opportunities when they come, because you won't have 500 big opportunities in your life. If you were born with a scorecard that gave you 20 chances to make important financial decisions throughout your life, and each major decision consumed one of those chances, you would think much more carefully about each one. If you went to a party and someone talked about a company you didn't even know what it did, or couldn't even pronounce its name, but someone swore it had made money in the past, you wouldn't buy its stock, right? But if you only had 20 chances, you would make much wiser decisions. That's what it means to act wisely and strategically with your financial choices. Regarding the companies we fully own, our strategy is very clear. We don't sell, no matter the amount someone offers. If someone came to us with a proposal to pay 3 times the value of a company like See's Candy, Buffalo News, or Board Shines, for example, we still wouldn't sell. I may be wrong in adopting this approach, but I know I'm right when I think about Berkshire Hathaway, because owning it entirely is exactly how I want to live my life. I have all the money I need, so what remains for me is ensuring the company's legacy and the work we do endure. Selling something just because someone offers a high price would be like selling one of my children just because someone offers me a high price. That's not something I would do, and I want to make it clear to my business partners that this is not a strategy we're going to adopt. They should understand this so they won't be disappointed with us in the future. More and more, with some of the stocks in our portfolio, we adopt the same stance. We don't sell for the sake of selling or speculating. Unless a real reason arises, such as a drastic change in the economic characteristics of a business, we won't sell just because the valuation is high. Now, answering a question I'm always asked, how do we calculate the intrinsic value of a company? Intrinsic value is the number that, if you knew everything about the future and could predict all the cash flows a company will generate from now until the moment of Judgment Day, discounted at the correct discount rate, that would be the intrinsic value of a business. In other words, the only legitimate reason to make an investment is the expectation of receiving more money in the future. That's what investing is, in the end. When you look at a stock or even a government bond, like U.S. Treasury bonds, it's very easy to know what you will receive because the cash flows are predictable and well-defined. However, when it comes to private companies or long-term investments, the intrinsic value is deeply tied to the ability to forecast future cash flows. And that's why understanding a business's value is crucial for any smart investor. The central issue here is extremely clear and precise. Cash flows are not directly printed on a stock certificate. This is a crucial point that often goes unnoticed, but it is at the core of any solid financial analysis. The job of an analyst is to transform that simple certificate, which is nothing more than a piece of paper representing a stake in a business, into something much more tangible and meaningful. They must be able to conduct a detailed analysis of what they believe will be paid in the future, which requires a careful evaluation of the cash flows this investment can generate. This conversion process, which may at first seem like a simple theoretical abstraction, is actually the foundation of a robust strategic analysis, allowing you to transform an ownership stake in a company into a well-founded forecast of the cash flows it will generate over time. This process is not limited to a mere exchange of assets. It is a transition from investing in a stock to a deep understanding of the return it may generate in the future. When we purchase something like new equipment for a business, such as Shaw, which manufactures carpets, we are, in reality, conducting this exact type of analysis. We're not just buying a machine. We're buying the ability to generate value in the future, the ability to generate cash flow. And this same logic applies not only to small businesses or family-owned companies, but also to corporate giants. Let's take a classic example, Coca-Cola. If you decided to buy shares of Coca-Cola today, the company is being valued in the market at around $110 to $115 billion. That is the amount you would pay to become a shareholder of the company. Now, the central question that arises is, would you spend that $110 or $115 billion today to obtain what Coca-Cola will deliver to you over the next 200 or 300 years? This is a question that demands deep reflection because it's not just a financial transaction, but a long-term commitment. Since a company's value is based on its ability to generate cash flow over time, the discount rate applied here loses some relevance as the time horizon extends. What really matters is not how much the discount rate will affect the value of a long-term cash flow, but how much money Coca-Cola will be able to generate over that time. This is something that is directly based on the fundamentals of the company and does not depend on volatile factors like the number of analysts recommending its stock, the trading volume in the market, or the stock price charts. What really matters, and what should guide any investment decision, is how much money you will be able to receive in return for the value invested. This is the core point of any buying decision, forecasting future cash flows and the degree of confidence you have about that forecast. This principle applies not only to shares of large companies like Coca-Cola, but also to any other type of financial asset. Whether you are buying a farm, an apartment building, or even oil in the ground, the reasoning remains the same. You are spending an amount of money now with the expectation that in the future you will receive a much larger return. Therefore, the question you should ask yourself is simple, but of great importance. How much money will you receive in return? When will you receive it? And, most importantly, how certain are you that these cash flows will materialize as expected? If you don't have clarity on these issues, you are likely exposing yourself to risks that could have been avoided. When I calculate the intrinsic value of a business, whether buying a whole company or a small part of it, I always adopt the approach of considering that I'm acquiring the business as a whole. This means I look at the company's future holistically, considering all aspects of its operations and growth prospects. The question I always ask myself is, what will come from this business and when? What you expect when investing in a company is that it will use the resources it generates wisely to increase returns over time. Let's take the example of Berkshire Hathaway. The company has never distributed anything to its shareholders over time. However, as the value of the businesses we own grows, our ability to generate returns and distribute them also grows. We can accumulate resources internally, but the real question here is, if Berkshire is being traded for about $105 billion, how much of that value can be distributed to its shareholders? This is a fundamental question because if you bought the entire company for $105 billion, you would be asking yourself, can Berkshire generate enough cash flow to justify that market value? This is the central point of any intrinsic value analysis. If you can't answer that question clearly and reliably, then you shouldn't be buying the company's stock. You might decide to speculate or follow the advice of others, like your neighbors, who buy stocks based on emotion or impulse. But if you can't answer this fundamental question about the company's intrinsic value, you're probably exposing yourself to more risk than you should. In my case, for example, I can't answer this question convincingly for many internet companies or for other businesses that are difficult to understand or predict. That's why I prefer to stay away from them, because that type of investment lacks clarity, predictability, and confidence in future cash flows, which are the foundation of any smart investment decision. Therefore, the central point here is the importance of clearly understanding the cash flows of an investment and how confidently you can forecast those flows over time. This is not about following trends or buying based on market hype, but about making informed and rational decisions based on what a company's future can really deliver in terms of financial return. The conclusion of this text serves as a powerful reminder that the biggest mistakes in the world of investing are often not made through wrong actions, but through failures of omission, failing to act when the opportunity arises. Warren Buffett, one of the most successful investors of all time, continuously emphasizes that success in investing is not just about seeking profits in the short term or chasing trends, but rather about understanding deeply what we are buying. This understanding must fall within our circle of competence, which refers to the areas in which we have a deep, informed understanding. It's about recognizing that investing is a long-term endeavor that goes far beyond immediate gratification, and that true wealth is built upon a well-grounded understanding of a business's intrinsic value, which is fundamentally tied to its future cash flows and long-term potential for value generation. Buffett warns us against the temptation of impulsive decisions, which are often based on short-term market movements or emotional reactions, such as the fear of missing out, FOMO, or following the herd mentality. The allure to sell when prices seem high or to make hasty decisions driven by a sudden market rally can often lead to costly mistakes. He stresses the importance of patience and discipline in the investment process. Instead of succumbing to these market-driven impulses, we should focus on finding companies with strong, sustainable business models, clear growth trajectories, and well-defined prospects. These are companies whose value is rooted in real, tangible assets and who can generate reliable cash flows over the long term. Buffett advocates for taking a long-term perspective when evaluating investments. It is not about attempting to time the market or make a quick profit from price fluctuations. True wealth does not come from fast speculations or trading in and out of positions, but from making thoughtful, calculated decisions that are backed by thorough research, detailed analysis, and a deep understanding of what drives the value of a business. This long-term mindset is essential, especially when investing in assets that we fully comprehend. This approach, according to Buffett, is what allows investors to build sustainable wealth, avoid unnecessary risks, and most importantly, avoid falling victim to short-term thinking that can ultimately jeopardize long-term success. Moreover, Buffett highlights that opportunities for exceptional investments are rare. Life and the world of investing are made up of moments and choices, and not all of these moments offer the chance to make significant financial decisions. When a great opportunity presents itself, it's essential to approach it with seriousness, preparedness, and a clear strategy. The ability to recognize and seize these opportunities is critical to building wealth, as they may not come around often. If we only have a limited number of chances to make critical financial decisions in our lifetime, we must be extremely cautious and strategic with each one. Recognizing when to act and when to stay disciplined, even in the face of uncertainty, is what separates successful investors from the rest. Finally, Buffett teaches us that the real value of a business lies in its ability to generate future cash flows. The only legitimate reason to invest in a company is the expectation that the money we invest today will be returned to us with a significant increase over time. This means that when evaluating a company or an asset, our focus should not be on short-term price fluctuations, market sentiment, or external trends. Instead, we should be concerned with understanding the long-term earning potential of the business and its ability to generate reliable cash flows in the future. This long-term perspective is essential, as it helps us avoid getting caught up in the whims of the market and ensures that our investments are anchored in the real value a business can deliver. The concept of intrinsic value is paramount in Buffett's investment philosophy and serves as the cornerstone of his extraordinary success. Intrinsic value, in its essence, represents the true worth of a business, grounded not in market sentiment or fleeting trends, but in the company's ability to generate sustainable wealth through its future cash flows. This approach is a stark departure from speculative practices that rely on short-term market fluctuations or emotional reactions to headlines. Instead, it promotes a disciplined, rational perspective, empowering investors to make informed decisions rooted in solid financial metrics. When we grasp the profound importance of intrinsic value, we unlock the ability to evaluate investments with a critical yet optimistic eye. It allows us to distinguish between fleeting opportunities and truly worthwhile ventures, ensuring that our financial choices are not merely reactive, but strategically aligned with long-term goals. This understanding becomes a guiding principle for achieving not only substantial financial success, but also for building a legacy that endures across generations. Warren Buffett's unparalleled achievements underscore the effectiveness of this disciplined and patient approach. His focus is never on immediate gains, but on the sustained growth of wealth over time. By concentrating on businesses with strong fundamentals, competitive advantages, and clear pathways to long-term profitability, Buffett demonstrates how strategic investments can withstand the inevitable volatility of markets and emerge stronger. This methodical approach combines rigorous analysis, a deep understanding of market dynamics, and an unwavering commitment to long-term thinking. It's a philosophy that not only mitigates risks, but also amplifies rewards. Investors who adopt this mindset are better equipped to navigate economic uncertainties, sidestep costly pitfalls, and capitalize on opportunities that align with their broader financial vision. Buffett's extraordinary results are a living testament to the power of this philosophy. They highlight how success is not born from chasing quick wins, but from a steadfast belief in the potential of businesses that align with intrinsic value principles. By prioritizing thoughtful decision-making, avoiding unnecessary risks, and maintaining a long-term perspective, investors can consistently outperform the market and achieve remarkable results. Ultimately, this commitment to intrinsic value and disciplined investing sets apart successful investors from the rest. It's a timeless approach that offers not only financial rewards, but also a sense of purpose and stability in an often unpredictable financial world. Whether you're an aspiring investor or a seasoned professional, embracing these principles can help you build a robust and sustainable portfolio, ensuring your financial success and creating a lasting impact for future generations.